Ever wonder what truly makes stock prices tick?
Hmm.
You're in for a wild ride today as we deep dive into the forces behind those market moves and whether anyone can truly outsmart the system.
It's a question that has fascinated academics and investors for decades.
Right.
And as we'll see, the answer is far from simple.
Our source material this time is a lecture aptly titled Investments. We get to eavesdrop on a finance professor who doesn't mince words.
Oh, this is going to be good.
He calls out flawed theories, highlights real-world complexities, and seems to genuinely relish a good debate.
From what I've gathered, he sounds like the kind of professor who keeps his students on their toes.
Exactly, and he starts off by admitting something that I found incredibly relatable.
Okay.
This whole question of how asset prices are really set? Well, it's kind of a mystery, even to the experts.
Yeah, he actually calls it a big riddle.
A big riddle, I like that.
And acknowledges that even after weeks of teaching, there's no easy answer, which, let's be honest, is a bit unnerving.
It is, especially for anyone who thought there might be some magic formula out there.
Right.
But that's what makes this deep dive so interesting. We're grappling with the unknown, just like the pros.
Precisely. And it gets us thinking critically about the models and theories that we often take for granted, like the famous capital asset pricing model or key APM.
Key APM. Everyone's heard of Key PM.
Right. The professor doesn't hold back, calling it primarily a neat theoretical construct, but not so helpful in the real world.
It's like he's taking a pin to one of those perfectly inflated theoretical balloons.
Yeah.
Why even bother with CEPM then?
Well, it's a common starting point because it introduces the idea that risk and return are related. But as you said, it has its limitations.
Okay.
Research by Fama and French back in the 90s really challenged its core idea that a stock's sensitivity to the overall market is the only thing that matters for determining its price.
So if market risk isn't the only driver of stock prices, what else is in the mix?
That's where arbitrage pricing theory, or APT, comes in. Instead of one single factor, APT suggests that multiple factors can influence a stock's price.
Okay, so multiple factors. Give us an example. How do you even begin to pin down what those factors might be?
Well, imagine considering things like inflation,
Okay.
interest rates, even the credibility of the central bank.
Yeah.
The professor mentions an early APT model from 1986 that incorporated 5 factors, but things have gotten a bit more complicated since then.
How complicated are we talking?
Well, there's now what some academics jokingly call a factor zoo.
A zoo.
Hundreds of potential factors that researchers have proposed. Size, value, momentum, you name it, someone's probably tried to build a factor around it.
A zoo is a good way to put it. Sounds like a real jungle out there. But if there are so many potential factors, how do investors know which ones are actually meaningful and not just statistical noise?
That's the million-dollar question.
Right.
The professor calls out this issue of data mining, where you can find spurious correlations if you look hard enough. It's like finding shapes in the clouds. They might look like something, but are they really there?
So how do we separate the signal from the noise? And more importantly, can we use any of this to actually get an edge in the market?
Those are questions we'll definitely want to keep in mind as we continue our deep dive. But first, we need to address a concept that turns traditional thinking on its head. The idea of a negative risk premium.
Negative risk premium. Doesn't risk usually equal higher potential return? Explain yourself, Professor. A negative risk premium. So you're telling me there are times when taking on more risk could actually lead to lower returns. My brain is officially bent.
I'll admit it's a bit of a head-scratcher at first, but the professor uses a very relatable example: unexpected inflation.
Right.
Most investors, he points out, hate unexpected inflation because it eats away at their returns.
Yeah, no one likes seeing their money buy less stuff. So how does this tie into a negative risk premium?
It gets interesting here. He argues that certain assets can actually act as a form of insurance against those undesirable events, like a sudden spike in inflation.
So you're saying investors might be willing to accept lower returns on those assets because they offer some protection if things go south.
Exactly. Think of it as a trade-off. You might give up some potential upside in exchange for that downside protection. It's like buying an insurance policy for your portfolio.
Okay, that makes sense. But how do we actually figure out which assets are the insurance policies and which ones are the high-growth, potentially higher-risk investments?
This is where those factor-mimicking portfolios we touched on earlier come into play. Remember, they're essentially bundles of stocks designed to track a specific risk factor, like that unexpected inflation example.
So instead of trying to predict inflation itself, you could potentially find a group of stocks that tend to do well during inflationary periods.
Precisely. It's a way to take those abstract economic factors and translate them into something concrete and investable.
And this ties back into APT, right?
Yeah.
Because if these factor-mimicking portfolios exist, then arbitrage opportunities could emerge if a stock's price gets out of whack with its theoretical value based on those factors.
Exactly. That's the beauty of APT. It provides a framework for understanding how these different factors contribute to a stock's price and suggests that the market, through the actions of arbitrageurs, should, in theory, correct any mispricings.
Should, in theory. But isn't that a big assumption? How efficient is the market in reality? I mean, we're talking about humans making decisions here, not perfectly rational robots.
That's the million-dollar question, isn't it?
Right.
And it's one that the professor grapples with directly in his lecture. He brings up a fascinating study that challenges even Fama and French's expanded model, the one that considers size and value, suggesting that some returns can't be explained by risk alone.
Wait, so if it's not just about risk, what else is influencing those returns? Is there something the models are missing?
That's the implication, and it points to the possibility of persistent mispricing in the market.
Ooh, mispricing. That has a certain ring to it. Like, maybe, just maybe, there are hidden gems out there that the market has misjudged, and savvy investors could capitalize on those inefficiencies.
It's certainly a tantalizing idea,
Yeah.
and the professor acknowledges the allure of finding those opportunities for alpha, that elusive outperformance that everyone's chasing.
But he doesn't give a definitive answer on whether it's truly achievable, does he?
He does not. And to be fair, if anyone had a foolproof method for consistently beating the market, they probably wouldn't be sharing it in a lecture hall.
Fair enough. So, where do you land on this whole debate? Is the market a perfectly efficient machine, or are there cracks in the facade where we might find those mispriced opportunities?
If I had a crystal ball that could answer that question definitively, we'd be having this conversation from my yacht in the Caribbean.
I'd be remiss if I didn't at least try to get you on that yacht, but I appreciate your honesty. So, no crystal ball, but years of experience and expertise. What's your take?
I think the truth, as it often does, lies somewhere in between the extremes. The market is incredibly efficient at processing information and reflecting it in prices, but at the end of the day, human beings are still driving those decisions, and we are far from perfectly rational creatures.
We let emotions get the better of us. We follow the herd. We chase after the latest hot stock tip.
Exactly. And those behavioral biases can create opportunities for mispricing, but exploiting those opportunities consistently is a whole other ballgame.
Speaking of which, let's talk about actual investor performance. Can the average person, even armed with all this knowledge about risk factors and arbitrage, actually beat the market? So we've established that human behavior can make things messy, even in a world of sophisticated algorithms and financial models.
Right.
But let's get down to brass tacks.
Okay.
Can the average investor actually beat the market? Professor Moneybags, lay it on us.
Well, he doesn't sugarcoat it.
Oh, no?
He actually shows his class a graph of mutual fund returns, and it's, well, let's just say it's not exactly inspiring.
A sea of mediocrity.
Pretty much.
Okay.
Mostly clustered around 0 or even negative after you factor in those pesky fees.
So much for those high-priced fund managers with their fancy suits and Bloomberg terminals.
Yeah.
Right?
There is a tiny sliver of hope, though.
Oh.
A minuscule fraction of funds do show consistent outperformance.
But is that skill or just dumb luck?
That's the question, isn't it?
Right.
The professor brings up a classic study analyzing the persistence of those stellar returns.
Okay.
And sadly, the results suggest that luck plays a much larger role than most people would care to admit.
So what's the takeaway here?
Wow.
If even the pros struggle to beat the market consistently, what hope is there for the rest of us?
Remember that quote from Fisher Black we mentioned earlier
Yeah.
about a market being efficient as long as prices are within a factor of 2 of their true value?
Right, so a stock could be priced at double or half of what it's actually worth, and he'd still consider that efficient.
Yeah.
That always struck me as a pretty generous margin of error.
It is generous, but Black believed that most markets are efficient most of the time, even with that wiggle room.
Okay, so maybe the market isn't a perfectly calibrated machine,
Right.
but it's not a total free-for-all either.
Right.
But this still leaves us with the question, what's an investor to do in this almost all-efficient world?
That's where things get really interesting.
Okay.
The professor points out that in practice, investors use a variety of approaches.
Okay.
Some have gone completely passive, simply tracking a broad market index fund.
Okay.
Others still cling to fundamental analysis, digging into company financials and trying to identify undervalued companies.
And I'm guessing there are still some folks out there trying to read tea leaves, or rather, chart patterns, hoping to predict future price movements.
You got it.
Okay.
And then there are the hedge funds employing complex strategies and high-powered algorithms to hunt for those elusive arbitrage opportunities.
Right.
And we can't forget about factor investing, which has become quite popular.
By factor investing.
Yeah.
Trying to capture those extra returns associated with things like size, value, or momentum.
Exactly.
Yeah.
But even with all these different approaches, the fundamental questions remain: how much of that extra return is compensation for taking on more risk, and how much of it is due to persistent mispricing?
It sounds like the debate is far from settled.
It's a debate that has raged for decades, and I suspect it will continue for many more. But even without a definitive answer, I think our deep dive has revealed something crucial.
Oh,
Even the experts are still grappling with the true drivers of stock prices.
yeah.
The line between risk and mispricing can be frustratingly blurry.
So relying on any single model, even one as seemingly sophisticated as APT, might not be the best strategy.
Precisely.
Okay.
Blindly trusting any model without understanding its limitations and potential pitfalls is a recipe for disaster.
Informed skepticism.
Yes.
I like the sound of that.
Yeah.
But if we step back from the academic models and the Wall Street jargon, what does all of this mean for our listener, the individual investor, trying to navigate this complex world?
It's a great question, and I think it boils down to a few key takeaways.
Okay.
First, diversification remains paramount. Don't put all your eggs in one basket, no matter how promising a particular stock or factor might seem.
The old "don't put all your eggs in one basket" adage,
Right.
timeless wisdom.
Indeed.
Right.
Second, remember that investing is a long game.
Oh.
Tuning out the day-to-day noise and focusing on your long-term goals can be incredibly powerful.
Easier said than done when the market is having a roller coaster day.
True, which is why having a clear investment strategy and sticking to it even when emotions are running high can make a world of difference.
So don't panic sell when the market takes a dip, and maybe resist the urge to chase after the latest meme stock.
Precisely.
Okay.
And finally, I think the most important takeaway from today's deep dive is this: never stop learning.
Yes.
The financial world is constantly evolving, new factors, new models, new theories.
It never ends.
Exactly, and that's what makes it so fascinating.
Yeah.
So stay curious, keep asking questions, and remember that informed skepticism is your best ally in this ever-changing world of investing.
On that note, we'll leave you with a final thought to ponder. If even the experts are debating the true drivers of stock prices, how much should any of us rely on predictions? Is the best approach not to outsmart the market, but to understand the forces at play and make informed decisions based on your own individual goals and risk tolerance?
Now that's something to think about.
Until next time, happy investing and keep diving deeper.